One of the most basic underwriting principles when it comes to qualifying for a home loan is the borrower's debt to income ratio. And it's important to know there's what's called a front end ratio and there's a back end ratio. Basically speaking, the debt to income ratio is how much money do you pay out versus how much money do you bring in. You take what's being paid out, you divide it by the gross monthly income, and it'll give you a debt to income ratio. The reason why there's a front end ratio and a back end ratio is because in mortgage financing, the front end ratio is taking that total monthly mortgage payment, that's the principal, interest, taxes, insurance, PMI where applicable, and even condo dues or HOA dues. Take that dollar amount, divide it by the gross monthly income, and that'll give you a front end ratio. But there's also what's called a back end ratio. And that's when you take the entire monthly housing payment, but then you add in everything else, whether it's student loans, credit card payments, car payments, alimony, child support, etc. And you take that number and you divide it by the gross monthly income using to qualify, and it'll give you a debt to income ratio. So it's always important that a home buyer qualifies with both their front and their back end debt to income ratio. And it's important for a mortgage loan originator to know that it doesn't matter how great someone's credit score is and how much money they have in the bank, if their debt to income ratio is not in line, then it's going to be very difficult for said home buyer or mortgage applicant to qualify for mortgage financing.